CNBC-TV18, embarking on a quarter century of excellence.
Across the board for the Asian markets, it's been quite good.
You're actually evergreening the loan. So what RBI said is that this won't do.
Probably we'll see some volatility in the first half, followed by, acceleration in the second half.
The announcement of acquisition of the beverage company from South Africa for about 1,320 odd crore rupees.
Large blocks in today's trade, here already done.
90 points higher, building onto our gains, very strong opening.
Now I start to worry about valuation.
Here we are announcing the launch of It Happens Only with Pizza.
It's not restricted to just NBFCs. The entire industry is likely to be impacted.
Optimistic of, maintaining our EBITDA margins to the tune of around close to 16%.
The Nifty is up close to about 0.5%.
Out of 15 states, we have a distribution set up more than 6 years in 12 states particularly.
The Life Insurance Council met yesterday.
Only FMCG and the IT index holding up and barely any gains to even speak of.
Well, this morning we saw a big record-setting rally on the markets. Thereafter, there were calls of caution and the markets turned from the highs of today's trading session so far. That was the day so far. You're watching us here on Closing Bell. I'm Mangalam Malu. Joining me are Reema as well as Sonia. Before we move on, just let's track the move of the market itself. The Nifty hovering around that 21,300 mark, a near 300-point fall from the highs is what we've seen. The day's high on the Nifty was 21,593, telling you that, there is congestion upwards of 21,550 itself. The midcap index has been the worst hit in today's trading session. Opened very well in the green with nearly 7-8 stocks advancing for every stock that was declining. But now if you look at it, the advanced decline charts, we have way more stocks declining than the number of stocks which are advancing. Over 2,000 stocks in the red for just about 250 stocks which are in the green right now. So these lines have not only intersected but have moved far apart as well. The midcap index itself is down around 1,200 points from the highs. The Nifty Bank, which failed to sustain above that 48,000 mark, has now fallen closer to 47,600 mark itself. And that'll be important to watch out for in the next hour as we have the weekly options expiry play out as well. What could be the reasons of this fall? The first one, of course, is the profit booking coming in on account of the huge rally that we've seen in our markets over the last couple of trading sessions, and not just that, trading weeks as well. There was euphoria in select pockets, no two ways about it, big listings of companies, IPO companies, etc. A lot of stocks moving around, and finally thinning institutional volumes as we wind down the year. So maybe some profit booking by a few pockets in the institutions before they close their books for the year as well. Just to tell you the kind of rally that we've had, the most recent moving averages of the Nifty, we're pretty close to that. 21,287 is the 5-day moving average on the Nifty. 10 DMA is 21,115, but it's just the 20-day moving average, which is 20,613. Looks so far away from where we are right now. So that's just telling you the way the markets have been moving. But on the way up, let's see what happens now, whether the Nifty goes back and claws back above those 21,380 marks or not. Tomorrow is the Nifty weekly options expiry, and ahead of that, the 21,300 call is extremely active in today's trading session with a fair amount of open interest build up as well. But that's about tomorrow. In today's trading session, the next 1 hour or so, we'll be watching out for how the Nifty Bank performs. On the way up, we have seen a lot of writing at the 47,700 call for a premium of 24-25 rupees. So does the Nifty Bank go ahead and conquer that 47,725 or not is the big question. But at the lower levels, we have some support in the form of 47,550. That's because the 47,600 put has been extremely active. So that's been the setup so far after what's been a volatile day of trade. Reema.
Well, it's the mid-cap index and the fall, the tanking, the carnage there, which catches your attention. This is the biggest fall on the mid-cap index since 23rd of October. We're looking back nearly 2 months. Despite that, after an 800-900 point fall on the mid-cap index, we're still back to where the mid-cap index was just about 10 days back. But it's a very, very sharp, sudden fall which has come through starting 1:30 p.m. And this fall in the markets comes despite upbeat global cues. So the CAC, the DAX, the FTSE are still holding up in the green. Some of the big losers today are the ones which are done very well. So, for instance, an IRFC, that's the one which has taken a big knock of 5%. It's a stock which has rallied 190% year to date. IREDA, we've been talking about the record-breaking rally on IREDA. That's a stock which has stumbled close to about 5%. PSUs like IOB, SJVN, and Indiabulls Real Estate too. Just naming a few, but there are so many stocks which are seeing this massive bout of profit-taking today.
Absolutely. And, let's not forget that this comes on the back of a very big rally. I mean, if you look at the Nifty, right, in the last 6 months, the Nifty has gained 2,500 points. So in a day, I mean, I guess this is par for the course, the kind of sell-off that we're seeing. We're just 170 points lower. And, as even Mangalam was saying, as we head into the end of the year, FI has become a bit inactive, right? They don't participate. So maybe you could see volatility in the markets as well. So I guess the way to approach it is not to get too perturbed. Some profit taking is perhaps likely because of the kind of run-up that we've seen. But I guess this is par for the course. Let's get Mitesh Thakkar now to give us some closing strategies. Mitesh, this is a minor pullback after what has been such a big surge for the market. So how are you approaching it now? And what is your closing strategy for the day?
Yeah. Good afternoon. So, this does look like some kind of profit booking led pullback. And while it's, you are rightly putting it in context of the rise, which you've seen still looks minor, I think this isn't over as yet. So the indicators on the hourly and 2-hourly charts are still negative, and therefore I think this pullback could be slightly deeper than what it is right now. My sense is that I think, in the worst case scenario, we are looking at a test of 46,650 thereabouts on the bank Nifty, which is about 900 points lower, which still would be only a partial retracement of the rally from 43,400 levels. So I think that's the worst case scenario. And similarly on the Nifty, the levels, corresponding levels could be closer to about 21,000 to about 20,900. So there could be another about 200-300 point kind of fall. So yeah, I think this could still be a choppy few days. But I think the idea is that this has kind of disrupted the momentum on an immediate basis. So we are trading with mixed bias. We are advising people to lighten up long positions, get out of index positions, maybe buy into some put options for December expiry or even January expiry, given the fact that you might want to hedge this out. So on the stock side, I have one buy and one sell. Voltas is something which I would recommend buying with a stop at 910 for targets of 965. And Aditya Birla Fashion, that's ABFRL. That's a sell with a stop at about 227 for a target of 206.
All right. Voltas and ABFRL. ABFRL has been a big underperformer in that space, and at the same time, Voltas has been doing well. Seen a lot of long build-up on that counter since the morning itself. Though the stock is off the high, still sitting with a gain of almost 4% in today's trading session. But the big mover today has been Varun Beverages, surging in double digits as the company has acquired the South Africa-based beverage company for 1,320 odd crore rupees. But not just today. If you look at the company's move in share price over the last few years since its IPO itself, it's been a big wealth creator. 18 times since its IPO in 2016 itself. And it's a bottler for Pepsi in India. 85% of its revenues and volumes come in from India. The remainder come in from 5 other countries. It's also, after this move, become the 7th largest consumer company in India by market cap, close to 1.6 lakh crore market cap. And it's behind biggies like HUL, ITC, Nestle, Asian Paints, DMart, Titan, and a couple of others as well. But importantly, it's also above some old big FMCG names like Britannia, Godrej Consumer, Tata Consumer, Pidilite itself, and some non-consumer names like Siemens, TVS Motors, Gales, and Dr. Reddy's too. Now, today's move can be attributed to this acquisition of a 1,320 crore from the South African bottler, which has the beverage bottling rights for Pepsi in South Africa, Lesotho, and Eswatini. Also, distribution rights for Nambia and Botswana. This deal adds 15% to the company's overall volumes, 12% to their revenue, and 7 to 8% to the EBITDA. Now, you'd wonder why 15% volumes and less contribution to the EBITDA, because 85% of the volumes of this company are generated by their own brand. So a move towards PepsiCo's brands would be more margin accretive for the company. So this brings out the triggers for Varun Beverages in the near term for this acquisition itself. South Africa's macros and demographic are extremely strong for the carbonated soft drinks market. 240 bottles per year are consumed by per South African person. But Pepsi is very little in that consumption, low single-digit market share in South Africa for Pepsi. That means there is headroom for further growth, and higher share of volumes coming in from Pepsi for the beverage company could aid their realizations and margins. And finally, 15% of the volumes generated by this company is through its own energy drink brand Reboost, which is a strong, fast-growing market, and it's an opportunity for Sting to go ahead and get that market share as well.
Okay, well, another takeaway here is also that domestic mutual funds have completely missed out on the super rally. And to understand how the shareholding pattern has been over the years, Thomas is also joining in. Thomas, what do you have for us?
Well, what a journey Varun Beverages has had, isn't it? 18x from its IPO, positive annual returns every single year since listing. Shareholders who have the stock have made merry, but there is a certain section of the market that has missed this fizzy rally, and that is India's mutual funds. Now, let's take a look at this chart, which shows you the holdings of both domestic and foreign investors. Now, Varun Beverages listed in late 2016, and at the time of listing, the FIIs had just over 8% stake, while the domestic funds had just started off with a 1% stake in the company. Now, domestic mutual funds first raised their stake nearly a year after the stock listed. Sometime in March 2018 is when they had close to 5% stake in the company, now compared to the 1% earlier. By then, the stock had already risen close to 50% in value. From that point until the next 6 quarters, the domestic funds continued to raise their stake until it reached a peak of around 6.4% towards the end of June 2019. Now, this March 2018 to June 2019 period also saw the stock rise close to 50% in value. Now, the stock in 2019 had also announced its first bonus issue of shares. However, since then, the domestic investors have continued to gradually pare their stake in the stock and trying to book profits that they have made over time. Now, domestic investors have reduced stake in Varun Beverages for 7 quarters in a row now, starting March 2022. And from that 6.4% peak, now they own only 2.2% stake in the stock, with no fund holding a stake in excess of 1%. Now, during these 7 quarters, the shares of Varun Beverages have tripled in value and have also announced another bonus issue of shares. Now, in contrast, the FII stake has risen from 8% at the time of listing to the current peak of 26.5%. Now, FIIs have also increased their stake in 6 out of the last 7 quarters. Some of the prominent investors that still hold a stake in the company include the Government Pension Fund and the Government of Singapore. So, it's been a journey to remember so far for Varun Beverages, one of the most successful IPO stories over the last decade, but some funds failed to see the fizz.
Okay, that's interesting. Imagine what would have happened to the stock if mutual funds had also participated, right? That the kind of potential that you see there. In fact, very interesting piece there. Thanks, Thomas, for that. Gurmeet is with us. Gurmeet Chadda, Managing Partner and CIO at Complete Circle Consultants. Gurmeet, so many questions here. One is that why was there no conviction with mutual funds, right, to buy into such a great story? And Varun Beverages is a stock that you have tracked for many years now. You know, you've known a lot in this space. Do you think there's more to go, or is a lot of the juice out already?
I think obviously, the best of the returns probably have happened, Sonia. And in fact, at my end also, I owned less of Varun Beverages, probably owned more of Tata Consumer. So we were also allocated, but probably the weightage was less. Sometimes you work with traditional matters like end of the day, it's a bottling partner. And sometimes, you tend to put different valuation metrics than you do to the innovators. But I think this acquisition will be very value accretive. South Africa sells almost more than 1 billion cases, which is 50% of Indian market. And they acquired the company at about 0.8 times enterprise value to sales. So it's a decent, value. And Africa, Pepsi is not strong, as Mangalam was making that point. Market share is hardly 3-4%. And the company also has its own brands. Plus, I think with Coke announcing the entry into alcoholic beverages, I think Pepsi will follow. So more segments like energy drinks, the high octane drinks, more non-cola offerings, I think. So there's room for growth, but I think valuations probably capture to a large extent of it. But as I said, this entire food category, whether it is Tata Consumer, whether it's now ITC making good moves, and this, beverages, I think this is a very fast-growing category. This is much better than your BPC, hair care, etc. So it's a high-growth segment. These are boring businesses. You need to take a 5-10-year view and just sit on.
Well, if you guys have a swig of Sting, you will know that it is anything but boring. The kind of energy rush that you get in Sting. It's been the highest volume generator for the company over the last 3 years. And in a matter of no time, what they've done is democratize the energy drinks market from a 75 rupee Red Bull to a 20 rupee Sting. And the other stock that Gurmeet likes, Tata Consumer, they've also come out with another energy beverage called Say Never for about 10 rupees itself. So this energy drink market, this, sachetization of energy drinks has really done well for India. No one really understood, this market until Sting broke through, and now even Thumbs Up has charged. Talking about all these things, Coke entered into the alcohol market. Gurmeet, do you like any of the listed alcohol stocks right now? Because, the market cap of Varun Beverages is close to 1.5 lakh crores. You add all the market caps of all the listed alcohol companies, you don't reach 1.5 lakh crores. So you have the entire sector available for less than what a Pepsi bottle costs.
No, I agree, and I think I think at these valuations, maybe United Spirits makes a lot of sense. They are doing premiumization. If you see the share of prestige and our brands is constantly picking up. It just slightly underperformed from the expectations it had when Diageo had a controlling stake. Some distilleries has done well, recently, and then obviously we saw a bit of a pullback. The only issue with some of these thin stocks is that as you approach elections, now I don't think so we have any state elections. I think we probably have now the general elections. Is the impact it can have on, because of freebies, can the excise and other duties go up? So that's the only risk there. So you got to be more tactical. With beverage and food, you can take a very long issue and hold them for longer. So it's just that probably beverages and food becomes core. Alcohol and some of the other thin stocks become satellite.
Got that. Any thoughts on Embassy? Blackstone has, done a very large deal of more than 20%. It's a clean-out trade. They're exiting. Not a very liquid counter, but any thoughts on Embassy?
At this point of time, probably InvITs make more sense. You have, let's say, power grid InvITs, some of the infrastructure InvITs. They offer you like a 9-10% kind of a yield with some potential appreciation as yields also come off. In fact, if you want, I don't say this is exactly fixed income, but let's say you want to take a less conservative option. I think the best option right now is 10-year GSEC. You buy it at about 7.15, 7.20. I think you will see multiple rate cuts next year. There's already this risk of COVID variant. I think that's also playing on the market today. The precautions Karnataka is taking and the cases in Kerala. I think there's some bit of a policy got to do with that. So rate cuts would mean yields will drop 50, 100 basis points, which means you can make 6, 7, 8% mark to market. So there's a double digit on the table with a simple offering like a 10-year government bond. I think that's a better option on the conservative side of the book.
Okay, Gurmeet, do stay on. We need to slip into a very short break. We'll come back and talk about some more stocks like Oil India. Oil India is doing very well in a down market. Some more details on that when we return.
CNBC-TV18, embarking on a quarter-century of excellence. CNBC-TV18, embarking on a quarter century of excellence.
Welcome back. The sensex has given up 71,000. The Nifty is on the verge of breaking below 21,200. In the morning, we were staring at record highs and very close to 21,600. And from that level, we're almost down close to about 400 points. Scary fall, even on mid-caps now. The fall is getting quite rapid and accelerating. The mid-cap index is down 1,050 points. There is no sectoral index, which is currently in the green, and the advanced decline ratio, let's pull that up. 350 stocks advancing for about 2,700 stocks declining, so very much skewed in favor of the declining stocks. But one stock which is on our radar right now is Oil India. It's surged. Vivek joins in with more. Vivek.
Well, that's right. Despite the steep fall that we've seen in the market, what's actually happened is Oil India has held up quite steady in the session today. The company recently held a select analyst meet, and Antique today wrote a note after the analyst meet. What they're saying is that they wanted to mainly check, the capex plans of the company as far as the upstream business is concerned, and also the progress as far as the Numaligarh refinery is concerned. After that, they've maintained the buy stance of the stock. The target price has been increased to 419 a share, and they've also increased the EV to EBITDA multiple that they were assigning to 3 times now versus 2.5 times that they had assigned earlier. Along with that, what they're saying is that the broader oil and gas price scenario remains quite stable, with realizations being capped at $75 a barrel and $6.5 dollars per MMBTU. Now, what are the key takeaways of the meet? They've come out quite enthused with the strong guidance that the management has provided. The company says they're on track to drive a 21% increase in oil production in the medium term. Along with that, they are on track for a 51% jump in gas production in the medium term, and are also on track to increase the refining capacity almost 3 times from the current level. What is Antique saying? They're expecting the growth to be driven by increased exploratory as well as development wells that the company is currently being drilling into. Secondly, what they're saying is that the company is this year planning to drill close to 65 wells versus the average run rate of close to 40 wells that they do on an annual basis. Capex plans too quite steady. 900 million tons envisaged in FY24. FY24 to FY26, what they have envisaged is almost $3 billion, US dollars. And lastly, Numaligarh's refining target has been increased, and looking to expand to close to 9 million tons per annum from the current 3 million tons per annum. So the capex plans, Numaligarh expansion, as well as the strong guidance given, all of them keeping the stock quite active in the session today.
Okay, thanks a lot for that. Well, the market sell-off is getting worse. To be honest, it's not looking that good at all right now. 21,200 is just about holding. And the mid-cap sell-off is quite severe, almost 1,300 points down now on the mid-cap index. But Gurmeet, this year, 2023, you've not got many opportunities to buy into any dips, right? So if this is a dip that has come through in the market, then what are the stocks you would keep in your shopping basket? I mean, what are the 4 or 5 names that you like now?
So I think the energy space looks pretty good to us. I think some of the traditional energy guys will do well. We benefited from Tata Power. We discussed that multiple times, including Smart Money. I think they're adding more capacity. So that's something we like. I think even if you look at BHEL, they have an order book of 33,000 crores. Some 55 gigawatts of coal-based thermal plants are coming up. 11 alone is from NTPC, 11 gigawatts. So I think that space is looking extreme. So energy as a space is looking extremely attractive. I think any correction in housing names, is pretty good. So some of the, the cable and wires names, the tile maker, the Kajarias of the world, I think that space looks extremely attractive. Also, I think the commentary around IT will change. So if you have a little more patience over the next 2 quarters, maybe this quarter numbers may not be great, but I think the commentary might change, especially in large cap IT. We saw a glimpse of that in Accenture. So if you have a slightly more patient view, maybe that also makes more sense. And, I think any correction we all wanted this. The small mid-cap index is up 30-40% this year. I mean, a 2-3% fall. In fact, that's the nature of the beast. I mean, it will go up, it will fall like this. So I have a staggered approach. I don't mind adding simply an ETF and just staggering it out. Also, these kind of falls, these are like, you can just simply take a small ETF also and then, just stagger it.
All right, take that point. A 2% fall after a big rally, not really a worry right now, Gurmeet. But, We are seeing a lot of these NBFCs not do too well. So what we'll do is, get Abhishek to tell us what exactly has happened out here, the RBI norms, and which stocks get hurt the most. And then we get your view in as well. Abhishek, which NBFCs do you think are in focus on account of this new norm?
Well, first to read about the norms, RBI said that transactions of regulated entities involving AIF, that is alternate investment funds, raised regulatory concerns. So they have noticed transactions entailing substitution of direct loan exposure to borrowers with indirect exposure via AIF. So regulated entities, that is REs, cannot invest in AIF scheme where downstream investment is directly or indirectly in a debtor company. So REs have been given a 30-day window period by RBI in terms of the lenders who have exposure over there to remove all the exposures. If at all the exposure is not removed, then there will be chances of 100% provisions after the 30th day that the deadline has been given by RBI. So if AIFs have first charge over the defaulting company's assets, the REs lending to this company must also provide additional capital against the loans that they have given out. So RBI new rules on AIF investment govern all the banks, NBFCs, cooperative banks with immediate effect. So exposure of lenders as per various analysts is as follows. IFL Securities note says that the exposure impacts the highest for Piramal Enterprise, India Bull Housing, Edelweiss and L&T Finance. L&T Finance, they have also mentioned that the exposure is mainly through ARCs that they have sold their bad loans to. Jeffrey says that there is exposure to Piramal Enterprise as well as IFL Finance. Back to you.
Gurmeet, do you own any of these NBFCs which could be potentially impacted, Piramal, whether it's Edelweiss, and would you change your assessment of these stocks based on this development?
Fortunately, no, none of this is in our portfolio. In fact, if you recollect, we did discuss about RBI will go after some stress they are seeing. First, it was risk weight on the unsecured side and banks lending to NBFC. Now, this measure, you will see possibly more measures. They're probably sensing some stress to real estate or lending towards real estate on some bit of unsecured lending. So let's say, for example, Bajaj Finance, less than 1% loans are below 50,000. So stronger, NBFC, this great, credit underwriting, strong liability base will probably outshine. But my sense is NBFCs as a category, especially which has high unsecured lending, could be a bit out of favor with, RBI probably doing more. The better option is to go for housing finance names or some of the private sector names. There is valuation comfort there. And they haven't done as well as the broader markets have. So stick there rather than, trying to do some value hunting in this space.
Okay, got it. Let's see. For now, I mean, it's actually been a very long time that this, the market has seen a fall like this. So there's still half an hour more to go. Perhaps one of the rare days when the traders are want the markets to shut earlier than they do, because they don't want perhaps the selling to get worse. But for now, it's restricted to a 200-point cut on the Nifty. Let's get our D Street chatter going. Nimesh will get us an insight into the dealing rooms as well as some tidbits about individual stocks. Nimesh, first on the market, right? I think this came out of nowhere, the sell-off that we saw today. Any indications on what's happening in the dealing rooms?
So, normally this kind of fall will not give you an indication and then fall, right? I mean, we've been seeing a relentless rally in the broader markets for the last many weeks now, or for that matter, many months now, right? And everybody's been now talking about valuation as a challenge, a bit of concerns. A lot of PMS fund managers are openly talking about not taking fresh money as well. So there was some pocket who was little discomfort with this kind of one-way rally. Again, today the Nifty is down 200 points, but that's not the story. The story is the broader markets. The midcap index is down to more than 2%, 2.5%, so to speak. And there is a big carnage in the broader market stocks. That stocks are down 10, 12, 15%. So that's where the big pain seems to be. And Sonia, for the last few days, the markets was ignoring the flows as well. For the last many days, the constant feedback was there is basket selling in mid-cap names by larger FIs. I mean, markets have been completely ignoring the FI flows and we're only banking on the domestic flows. So I guess that could be one of the explanations as to why we've seen a bit of a correction or a fall, or so to speak, profit booking in the broader markets today. Even in today's trade, the feedback is, Sonia, there is basket selling. Normally we call it as market at close selling in the mid-cap basket at a leading FI. So the cash stocks were getting sold by the FIs, and looks like now the market is taking a cognizant and reacting as well. I haven't found any specific reason for today's fall. There has been a lot of chatter or a rumor as well about some raids on some brokers, some selling by some capitulation for one of the funds and all. But again, that's all hearsay. Very difficult to pinpoint a specific reason for today's fall in the mid cap and small cap. The only reason is for the last many days, the markets have been ignoring the fact that the FIs have been selling mid caps aggressively in the last many days. Having said that, while you're seeing profit booking across the board, some bit of green take is visible in the consumption stocks for the second day running. So there is sector churn happening, and consumption has now seen as a bit of a defensive bet for larger FIs. So that's where some bit of buying flow seems to be. But I guess today's big carnage is in the broader markets, and that is something to take a note on. It doesn't look like it can end in a day or two because we've seen a big rally, but that's something which can be a bit of a pain point, at least in the near term, the big pain in the broader markets.
Even after the fall that we've seen today on the mid-cap index, we're still back to levels where we were at the beginning of December. So it's not that it's been a serious correction. It's just about we've erased 10 days of moves on the mid-cap index, and on the Nifty, just about 4 trading days worth of moves has been erased with today's fall. But Nimesh, tell us the stocks that you have on your radar.
Sure. So the first stock on my list today is Taneja Aerospace. In a weak market, especially when the broader markets are down so much, that stock is up 10% and on decent volumes as well. I think the stock has got excited because there is a notice that the board is going to meet on December 22nd for fundraising. But I understand the fund in that fundraise, most likely the promoter entity is likely to infuse fresh capital into the company. So that's something to track in Taneja Aerospace. The second stock is Gujarat Fluoro. For the second or the third day running, that stock is outperforming the broader markets. Even in today's trade, the volumes are on the higher side. Some bit of H&I interest seems to be back on Gujarat Fluoro as well. And potentially there could be some deleveraging as well in Gujarat Fluoro going forward. So that's keeping the stock exciting in today's trade. And the last one is Shriram Pistons. Again, there was a large block in pre-open. Nearly 10% equity got changed hands. I understand the German partner was a seller in today's block, but a leading AIF was a buyer. So the disclosures will be quite interesting. A single buyer, which is an AIF, that has bought the entire 10% in Shriram Piston today.
All right, Nimesh, interesting names as always. In a falling market, all these stocks are a buzz, so we'll keep an eye out on developments out there. Just before we slip into a short break, it is 1 minute past 3 p.m. and usually, we do see a move on the Nifty Bank at 3 p.m. on options expiry days, and this move has come on the obverse side, which is the lower end itself. The street was positioned for some support at 47,600, but as the Nifty Bank fell below that 47,600 mark, the fall has accelerated. Now it's closing in towards that 47,530 mark. 47,500 put writers are extremely active. So let's see whether this number, 47,500, acts as a bit of a support in the last half hour or not. We'll keep an eye out on this. Come back, and on the other side, we'll also get chatting with Shibani Sarkar Kurian, who's the Senior EVP and Head Equity Research at Kotak Mahindra AMC.
CNBC-TV18, embarking on a quarter century of excellence. CNBC-TV18, embarking on a quarter century of excellence.
Okay, what a turn of events, right? There's no stopping this market sell-off. The Nifty is now down almost 300 points, and it's quite rapid, the kind of fall that we've seen. There's nothing to really explain it. There's no major reason for the sell-off. It's just perhaps some profit-taking after a sharp run-up. Shivani Sarkar-Kurian, who's the Senior EVP and Head of Equity Research at Kotak Mahindra AMC, is joining in. Shivani, a surprise turn of events, right, in the last 1 hour or so. I don't think anyone would have expected the severity of this fall. But be that as it may, how does one approach it now?
Hi, good afternoon, Sonia. Yes, so we've had a tremendous rally over the last month or so, and therefore some amount of profit booking could possibly be explaining why we've seen this turn of events. But having said that, if you look at our markets, three key things have been driving markets. One has been the fact that India's macro growth outlook is significantly better than the rest of the world, especially the emerging market pack. Our earnings has been holding up much better. And in fact, after the first half, the ask rate for the second half of the year in terms of earnings seems to be pretty much achievable. And therefore, that is what is also helping markets. And domestic flows have been quite strong. And despite all of market fundamentals, when you look at FIIs in terms of their holdings in Indian markets, that is at a decade low. So therefore, markets have been clearly supported from domestic factors. And even from an earnings perspective, domestic facing companies appear to be better placed. Now comes the question of valuations. And what we have been really saying is that when you look at large caps, valuations are not still in that expensive range. They are slightly above long-term averages. Though mid caps and small caps in terms of their absolute as well as relative valuations are above long-term averages. And therefore, our view is that the overweight stance somewhat in terms of large caps where valuation comfort still exists continues. Now, within the mid-cap space, I must say that the earnings trajectory remains very strong. And therefore, one has to be just careful in terms of avoiding froth, looking at companies which have run up because of poor liquidity or where there is excessive valuation. But net-net, the earnings trajectory overall for the market as well as a broader market will likely help support, especially in the medium term.
Right. Shivani, your thoughts on some of the sectors as we speak. You did like a couple of these large cap IT names. They have done well over the last 2 weeks or so as well. And importantly, the outlook for the industry perhaps may improve given the Fed is looking to cut rates. Do you think it's a good place to be right now from a 1-year perspective, given that they've done nothing?
Yeah, so if you look at valuation comfort, large cap IT and large cap banks, these are two segments where there is clear valuation comfort. Firstly, in terms of large cap IT, as you asked, the overall near-term outlook remains fairly muted. Therefore, there are still no great green shoots that you're seeing in terms of recovery and demand recovery. But clearly, what has happened over the last 1 year is that the entire deal win momentum has been fairly strong, especially the large deal win momentum. And therefore, over the next maybe 6 to 12 month period, as these deals start to ramp up, you may start seeing some amount of that recovery. The fact is that interest rates are possibly at peak also help in that context. So we will have to wait and see in terms of recovery and what clients are saying in terms of their spends on budgeting for the next year. But yes, clearly from a valuation perspective, large cap IT at this point in time is possibly better placed than the mid cap space, which has seen a sharp run up, and now valuations are uncomfortable. So we would be selective on mid caps and prefer large cap IT at this point in time.
But mid-caps have corrected, right? Many of them are down 5-6%, some of them going up to a 7-8%. Is today a good day to buy into individual stocks or deploy lump sum money? SIPs are ongoing irrespective of market levels. But if someone is waiting by to deploy a lump sum, a one-time investment, is today a good day, or do you think we could see lower levels?
So, whatever we have seen today comes after a very, very sharp run up, and therefore it's not a very meaningful correction to that extent. We have always been advising that staggering investments is possibly the better way to go, especially where mid and small caps are concerned. Given the fact that over the last 12 months, we've seen this stupendous rally in the space, we believe that, as I was discussing earlier, that the earnings trajectory for many of the domestic facing businesses, specifically within the mid and small caps, remains strong. And therefore, yes, if there is a correction in the market, you would possibly use that correction to build positions in high quality, high growth mid caps when valuations become more comfortable. But staggering makes always a little bit of sense, and especially that this is today just a small correction that you've seen after a very, very sharp run up.
Okay. Actually, some of these spaces, right, are doing very well. So, for example, the mid-cap IT space, I mean, the stock that we're seeing right now on the screen is Birlasoft. It's been one of the biggest movers this year. And a lot of these companies, these tech companies, are going big in spaces like generative AI, for example, whether it's something like a Happiest Mind, Scient, etc. Any of these themes that you still like? If there's a dip, would you buy into any of them?
Yes, absolutely. So I think that, what's happened within the IT space is some of the smaller companies, mid-cap companies, because of their size, have been far more agile. Also, a lot of investments have been made in building capabilities in new age technologies, whether it be digital, whether it be AI, or even on the ER&D side. And therefore, what we have seen is that over the last year, while the sector has seen muted outcomes on revenue growth, some of the mid-cap names have shown faster growth. And this is a sector where typically multiples re-rate with revenue growth trajectory. And that's what's happened where some of the mid-cap names are concerned. However, at this point in time, given the very sharp outperformance, we've seen that in pockets, valuations have become extremely stretched. And therefore, while there would be pockets where we'll still be liking the company from their overall growth profile, we would possibly wait for better valuations as an entry point. And hence, at this point, we would be selective where some of the mid-cap IT names are concerned.
All right, Shibani, thank you so much for joining in and giving us your views on the market. As of now, looks like it is just routine profit taking. Valuations are still elevated, but some of the pockets do look good from a long-term growth standpoint, and in the near term, a couple of these IT names on account of valuations. Meanwhile, for the Nifty Bank, it has held on to that 47,500 mark. It briefly dipped below that, and thereafter it saw a bounce back about 30 points above that 47,500 mark, still holding above that. So chances are maybe it expires between that 47,500 to 47,550 mark itself. That's what the options are positioning themselves for. We've seen a fresh bout of selling in a couple of these Adani Group names as well. Adani Ports, for instance, is now at the low point of trade with a cut of almost 5.5%. There's a 7% fall from the highs. Adani Enterprises, Tata Steel is the other, notable decliner that we are seeing right now. The metals index too is down by about 4%. Tata Steel down 4% as well. Good time to get Mitesh Thakkar back in today for the tomorrow trade. Mitesh, what do you feel like doing today? Shorting today to be able to cover tomorrow, or maybe buy this dip and hope to profit book tomorrow?
No, I think we'll take some shorting positions given the fact that, we are reversing from extremely overbought situations. There's a higher chance that, this extreme overbought will correct itself. Therefore, there would be, a slightly bigger pullback than what we've experienced till now. So I think the odds are in favor of taking some short position or cutting down your long exposure. So on the Bank Nifty, would recommend, taking a STBT kind of a trade, keep a stop at about 47,575, so which is roughly about 130 points higher from here, and look for a 200 point kind of a decline to about 250 point kind of a decline, which could happen in the Bank Nifty tomorrow. That's the call which we are taking. And on the stock side, we'll take STBT on Titan with a stop at 35.67 for targets of 35.20.
Spoke too soon on the 47,500 mark, because just as we spoke, it's not only broken the 47,500 mark, it's fallen 100 points swiftly from there itself. 47,400 is perhaps now looking vulnerable.
Oh, absolutely. And it's been, I think the pace of the fall is something that has surprised everyone. Everyone is expecting some kind of a fall to come through, but not so much in such a short span of time. All right, let's do one thing. There was one person earlier in the day who, came out with this cautionary note. Ashwini Agarwal, founder and partner at Demeter Advisors, he said in the morning itself that he's very cautious about the market. He said that one needs to remain, or rather one needs to move to cash now or look at debt funds, the debt side of the market, because equities have become very heated. Listen in, and we'll take a short break and be back.
US soft landing is what the market is now hoping for, and that hope has crystallized in a significant way after the US Fed meeting last week. And of course, before that, we had the Indian state election outcome. So these two rockets, I would say, have propelled the market, over the last 2 weeks. Now I start to worry about valuations, and I'm starting to think that, markets possibly getting a little bit overstretched. Asset allocation is one great way to manage risk. And, at this point in time, what I'm doing is gradually building up my cash position, reducing equities. And that's how at least I'm doing it. Now, increasing exposure to debt, for example, would be a good thing to do. Interest rate cuts will happen. Now, whether it's 1 or 2 at the Fed or 3 or 4, we'll have to see. But interest rate cuts will happen, and they will follow through in India as well. Sectorally, I mentioned banks, I mentioned downstream chemicals, I mentioned pharmaceuticals, maybe some IT as well, though IT trade, I think, is pretty much done. Maybe a little bit of IT as well as a defensive position.
CNBC-TV18, embarking on a quarter century of excellence. CNBC-TV18, embarking on a quarter century of excellence.
Welcome back. The fall on the Nifty has accelerated right now. We're below that 21,150 mark on the Nifty as well, which means that it's a near 500 point fall on the Nifty from the highs. For the Nifty bank as well, 47,400 has been taken out. It's a sharp knife through warm butter. That's exactly what it is right now. We've seen that swift fall, and on the mid-cap index, the index itself is down 1,600 points. When he started the show, it was down 1,200 points from the highs, and now it's over 2,000 points off the highs as well. And that's visible in the way the India VIX or the volatility index has moved as well. Reliance, which has been leading the rally, has now fallen 3% from the high. So that's causing further pressure on the market. Nifty holding that 21,100 mark by the skin of its teeth. Nifty Bank firmly below 47,400 as well. Mayuresh Joshi now joins us now. He's the head equity research at William O'Neill. Mayuresh, it's been a big fall after what was a huge rally. In this fall, if one believes that the uptrend is intact, what are the pockets that look interesting?
Afternoon, Mangalam. I think a large portion of the market was of the belief that the broader market rally that we had probably seen, there would be some element of profit booking which will come through. And it seems to be the case at this juncture. Having said that, I think where the earnings trajectory is expected to still hold out, our own sense at Marketswatch India is when we probably look at our EPS and RS rating structures, auto ancillaries as a pack very selectively probably look very, very attractive even now, and with the fall even more. Mid-cap IT, again, very selectively looks both a defensive bet and where the earnings outlook probably might continue over the next few quarters. And a few of the names within the larger basket of infra/capital goods, because this is one theme which will continue. It's earnings pedigree, good execution happening on ground. We are probably entering into a good phase where the capex, both from the government and the private side, will continue for a longer periodicity of time. Albeit the next 2 quarters, because of general elections, there will be a slowdown in orders. But the existing order books are good enough with the execution that they are doing, expecting good operating leverage to play out here as well. So I think these 2-3 pockets looking a little bit more interesting, Mangalam, as we speak.
Okay. I wanted your thoughts also on the auto names, because there's been a big comeback over here, especially in some of these rural plays like Hero MotoCorp, because of increased demand due to the wedding season, etc. Do you think there's still more to go on the upside for the auto companies?
Afternoon, Sonia. I think that seems to be a possibility, because what you've probably seen in terms of volumes and the product mix that a lot of these two-wheelers have, specifically case in point being TVS Motor, has been a huge outperformer, both in terms of its original product on the original product doing well and iQube doing equally well as well. Having said that, again, I think the kind of valuations that these companies are now trading at a tad bit higher than the long-term means. And therefore, I think the expectations that's getting built in view of competition, expectations of two-wheelers and the existing two-wheeler players in the unlisted space, some listed offerings expected to come through in the next few quarters, might bump up the overall valuation picture for this space. So the space is attractively poised. Valuations had bit on the higher side. As a disclaimer, we continue holding on to a stock like TVS Motor into our global portfolios. But auto ancillary, Sonia, as I mentioned, look very attractive. Our sense is battery makers, case in point, Exide, Amara Raja, probably look reasonably placed both in terms of both the internal combustion engine batteries that they're providing and the additional capacities that they're probably building up, which is expected to come up over the next few quarters. Input costs have come down sharply, which means margin stability can be expected. So to that extent, earnings growth should hold out very comfortably for these battery makers. And the transition will be equally good, both from original equipment manufacturers and the replacement markets. So I think battery makers is something that we like, but one can continue holding on to two-wheelers, specifically TVS Motors, per the disclaimer I brought.
Today's listing, DOMS continues to hold up pretty well. Stock is still up about 67, 68%, just shy of that 1400 rupee mark. versus the issue price of 790. Between flare writing and DOMS, Mayuresh, which one would you prefer and why?
Afternoon, Rima. So I think I saw the tweet that Mangalam had put forth, and I completely agree with him. If you look at players, DHRP, or even if you look at Link's presentation, where they've put out the industry size. So the overall industry size, including pens, pencils, highlighters, stroke markers, as on FY23, stands around 6,600 odd crores, expected to grow at a blended basis around 7.5% to around 9,500 crores, where pens would probably be around a large part of the market share, highlighters, markers around 750 crores, and pencils should grow from around the 1,800 crore market size to around 2,500. So I think a large part of the market is being dominated in these spaces by either Link pens, by Flare or DOMS. But the kind of expectation that one has post listings, I think they are commanding a market cap which is in excess of the overall market size itself that the market itself has to present. The stationary market, I agree, is far larger. And therefore, I think the expectation in terms of whether these earnings will hold out with the market share that these guys have might be a probability, but valuations are too steep, in my opinion, at this juncture. So I'll have to wait out for a significant fall on these stocks to probably have a better entry point. At these prices and valuations, it does not make sense.
You know, it'll be very interesting to see what happens to names like ITC, because now in such markets, people start ascribing values to even the smaller businesses of larger companies, etc. With DOMS, which has about 8,500 crores in terms of a market cap, has 12% market share of the stationery market. Guess who's the leader out there? It's ITC, which has 20% market share of the Classmate range of stationery products that they sell. So if 12% of market share equates to 8,500 crores in market cap.
And what's DOMS market share?
12%. And ITC is 20%. So, ITC technically, the Classmate business should be 1.5 times higher than that. So, our analyst is going to ascribe value to ITC's stationery business now to the tune of almost $2 billion.
And then call for a demerger and an eventual listing, right?
These are the vagaries of a bull market, Rima.
All right, we're just about counting down to the market close. Mayuresh, thank you very much for joining in. It's been a rough day for our markets. This is the first real profit booking that we've seen in our markets. The Nifty is ending down at 21,100, 350 points lower as of close. And from the day's high, it's a good 500-point correction. The Nifty in the morning hit a record high of 21,593 and we're closing at 21,100. The sensex is seeing a fall of more than 1,000 points. The midcap index, Hormus is just telling me this is the biggest fall that we've seen on the midcap index since February of 2022, with a fall of 1,500 points, 3.5% gone there. The advanced decline ratio, 300 in the green for about 2,730 stocks in the red. And I think in terms of the Nifty gainers, you've only got 4 stocks. ONGC is 1, Tata Consumer, Britannia the other 2, and Cipla is just deciding whether it's going to close in the red or the green.
There's a saying, right? The markets take the stairs up, but the elevator down. Yeah. So it's really the kind of fall that we've seen is it's been very ferocious. Just in the last 1 hour of trade, we've erased a lot of what we gained in the last many days. So 350 points lower on the Nifty. The mid-cap index is really been terrible today in terms of a performance. 1,600 points down. So let's talk about some of the losers. Double-digit losses in Indiabulls Housing Finance, Reliance Power, JP Associates, Indiabulls Real Estate, IOB, Dish TV, UCO Bank. All your PSU banks have fallen quite a bit today. Central Bank of India, etc. Yes Bank is also generally a high beta name, so down about 8% today for Yes Bank. Nalco down about 7% or so. Coffee Day, BHEL, IRB Infra also under a lot of pressure. No point really talking about more stocks because overall I think the market has just taken some money off the table. On the gaining side, Oil India, PC Jewelers and Vikas Global. I mean, don't want to talk about that name because it's like a 3 rupee stock, but just goes to show that there are hardly any gainers in trade today, mostly a bunch of losers, and the first real signs of profit taking is what we've seen in the market today.
And as it turns out, the last tick on the Nifty is well below that 21,100 mark. Of course, the closing will be a lot above that because of the averages and the volume weighted averages. The Nifty Bank 2 is holding around 47,250. A big correction is what we've seen in the frontline indices. The story of the day could be told in a couple of charts. The first one, when we opened the market today, we had 50 Nifty stocks in the green, and now as we close, we have just 3 of them just marginally in the green as well. Same is the case with the mid-cap end of things. When we opened, around 10 stocks were gaining for just one stock which was losing, and now there are nearly 10 stocks which are losing for one stock which is gaining. So a complete about turn in the second half of trade today, Rima.
Tomorrow's going to be an interesting session. Does the sell-off continue or will the markets rebound? But we're going to take your leave and closing bell. Don't go anywhere. Markets Forward comes up next.
CNBC-TV18, embarking on a quarter century of excellence.